Top of the morning to you here on a Thursday in Starter San Diego. The Mortgage Geek, Sean Cahan, is here, and we're going to drop some serious knowledge about what's going on in real estate and the mortgage market, especially. Is the mortgage market the dog or the tail in real estate right now?
Whoa, I like that one. It should be the dog, but
right?
It's always been the tail.
That's so
I am
weird.
a service provider. I'm a service provider. Let's say someone's done one transaction.
No problem.
I'm still a service provider.
Yeah.
To that one person.
That's right.
The expertise of nothing, not saying that this is happening, but the expertise that go into being a high producing loan officer, very difficult. There's a lot of guidelines. If this happens, this happens. But if this doesn't happen and this happens, then it completely changes the outcome. It's like you got to follow the yellow brick road to get the outcome. Right?
And the way it's implemented is always not straightforward as well, like the new VA Cashout stuff.
Oh my gosh.
And the things like that, they're saying, hey, you have to have a document like this, but we don't have that document. You just need to make a document that has this stuff. I mean, so there's crazy stuff like that that's going on in the mortgage market. And typically, and what I mean by this question, and what we're trying to get to is, we've seen the last crash was sort of caused by mortgages, or a lot of people would believe that.
Yeah, correct.
And so, or the loosening of credit, let's call it that.
Yeah,
not
I
by
like
mortgages, but the loosening of credit. And so, and you can see when credit tightens, it affects the real estate market. So really, my opinion is the mortgage has always been the dog, but people think it's the tail, and that's what screws things up. So if you look at what's happening with credit, you see that right now, it seems like, what would you say right now? Do you think things are loosening or tightening in the credit space?
Well, it's weird. They are loosening, but they are tightening under certain guidelines, which are kind of like, hold on, why are you getting rid of this over here and making this tighter over here? Like, for instance, Wells Fargo on their, should I say Wells Fargo?
Yeah,
I
sure.
can.
Yeah, it's okay. It's true.
Whatever. Wells smells Fargo. I was on the phone with an underwriter, and they have a new rule under their non-conforming that if the CP, say that you have a K1 and you have 50 or 70 or 100%, and you get ordinary income on line one. I mean, that's a pass-through, right? You claim it on your tax return, your personal tax return, you pay tax on it. That's your income. Down on the right-hand side of the K1, there's a distribution. So a lot of CPAs don't put they actually took money out, right? Because it's like, well, it's just passed to you anyway. Well, now Wells Fargo goes, well, the CPA didn't put that you took a distribution, so you didn't actually get that money.
Whether you received it or not.
It's an actual pass-through to me. And they're like, I know, but this is an exception. That's weird.
So tightening and so confused then, you would
Yeah.
say. Not necessarily tightening or loosening as a whole, but just a little bit confused. There's been, there's not outrage about things that are happening in general. So there's things that are happening specifically, like the VA thing is because, veterans are being targeted by companies who are churning deals, refining people.
Freedom. They got in trouble for that.
Yeah, there's a lot of people who got in trouble for that. Big companies that were, essentially making a frontal assault on, VA mortgages and trying to get people who had just gotten into loans into different loans. And so that made sense, right? It makes sense to go, hey, let's tighten this up.
And then they were hitting the EPO on the person that first originated the loan too.
Correct.
That was pretty nasty for a little bit.
And that's not fun for anyone.
No.
So that makes sense. Then there's other things that are loosening. There's some amazing programs that you have access to. Bank statements, self-employed. I mean, you've got a bunch of stuff for self-employed people.
Well, I think, so they already said, and I think I mentioned this last time, the non-QM sector. So like in 2017, it was like 20 billion, 2018, it was like 10 billion and then $20 billion. And now they're expecting 2019 to be 50 to 60 billion under the non-QM, like the one-year jumbo tax return. 12 or 24-month bank statement loan, just high DTIs. Like we do a 12-month or 24-month personal and business bank statement loan that now goes to a 55 DTI.
Wow. That's wild.
It's wild.
I would say that's loose credit, right?
Definitely.
So
collateral based.
Yeah. Yes. So lower LTVs.
No one's going to walk into hey, if you're buying a $1.5 million house and slapping down 400 grand, the likelihood of you failing or walking away from it is just, I don't know, low percentage.
It's low.
Yeah,
It's a
very
lower
low.
risk.
Yeah, very low risk.
Personally, that's just makes sense to me.
Doesn't make
I wouldn't
sense
even
on the
call
credit.
that like loose credit. I would call that just like make sense, common sense credit is what I would call that.
Yeah.
So that I wouldn't even call that loose. What was loose was, 600 credit, 100% 80/20s, with arms and balloon seconds. That was loose credit. But we don't see that. So I think the biggest threat to the real estate market would be a tightening credit scenario, which could be possible. We saw, mortgage originations, overall volume is down a lot across the country in just overall, originated deals. So if you see certain, banks or lending institutions lose money, which happened quite a bit last year, surprisingly, even though the market was still pretty good, a lot of people kind of overcooked it with what their expectations were. So a lot of places lost money. And when they start tightening things up, will that go to guidelines? Will it happen on overlays? Will credit, seize up a little bit? That, I think, is the greatest threat to the real estate market.
Freddie Mac just changed their guidelines on rental income.
That's true.
Yeah. I mean, that's what they're really trying to pinpoint is to make sure that someone with a higher DTI, a little bit less loan to value, or a higher loan to value, a little bit less equity, their ability to repay that loan is really kind of set in stone. Like, there's no funny business going on. They really want to make sure that, hey, if you own this other property, like, you need to sell it or you need to actually rent it, and you need to qualify just in case, like, hey, your toilet's broken. Oh boy, can't even fix that.
Yeah.
That's literally what was happening.
No, yeah, absolutely. And it makes sense too, because
like a flat tire away from being broke.
Yeah, which is not good for a homeowner, because something will come up.
Yeah.
It will.
People will force you into that. That's what I'm saying. Like, not force it. Everyone, hey, homeowners, you guys sign the paperwork, right? Loan officers, you explain it. Like, there's guaranteed going to be some miscommunication, but it's not just one party like, my loan officer didn't tell me. The homeowner did this. It's like, hey, everyone's in the bucket together.
Correct. And then I think that, with investment properties, and I think the reason why Freddie Mac tightened those guidelines is because people were buying stuff as an investment property based on, projected rental income.
Number one fraud, 2018.
Is that right?
Yep. Was the property. So what they were doing is, that's the number one fraud. People were buying primary homes that they couldn't actually afford. And so what they're saying is, hey, switch this over to an investment property. We'll use the future rent to offset the payment. We'll get you in there, and then they actually moved in.
Right. So no rent coming in.
Yeah.
So way different scenario than what was in the paper as far as the risk assessment is concerned. And that's not good.
Yeah.
In catching things like that, I see that as a good sign. I see the move by Freddie, and I assume Fannie will follow suit.
Absolutely.
But I mean, I see that as a good sign. They catching it before, they notice it, they recognize it. Okay, hey, this was a big deal in 2018, 2019, change.
Yeah,
fix
correct,
it.
correct.
Let's not just let it go.
I think it actually started in 2017 when it was like becoming a bigger push, right? Because like the home prices started increasing, the interest rates started going, people can afford less. How can we still get the home that we want?
What's the big thing that's going on right now, sort of in the lending space, or trends that you see with, the different elements between the retail banks, mortgage banks, brokers?
I think that the number one thing that we're seeing is that banks or brokers and institutional banks are just pushing out loan approvals based upon applications, and it's bad. Like, I don't know any direct mortgage banks or that will allow the loan officer, allow the processor to just send in a file and, hey, we'll underwrite it and send you 50 conditions. I think that I was having a talk with another branch manager, and he was saying the exact same thing. He's like, man, all my loan officers are saying, let's go over to UWM or be a broker and sell to UWM or Quicken and all those types of things, and they don't realize, like, yeah, you can get a loan approval off of 1003, but does that mean that your loan's going to get approved? Like, we're just seeing more denials, like, way down the line, day 25, day 26, day 27, because when the market starts to tighten up, right, in terms of funding, then what happens is, like, technically speaking, the lower half of the producers you know, all they were able to sell was interest rates. So then they're like, oh my gosh, where's the cheapest interest rate? So then they start going over to brokering because the interest rates are lower. But it's like, man, you didn't know how to put together a loan from the very beginning. That underwriter that you work with that's in your office is the one who structured every single one of your deals. So they're sending in at 10:03, oh my gosh, I got loan approval in 3 days. No, you don't. No,
So they're actually issuing loan approvals?
Yes.
Not pre-approvals.
No.
Loan approvals.
Loan conditional, because they just class it conditional. Conditional loan approval.
Is the condition that you actually qualify for the loan?
Yeah, pretty much. Like,
upon you actually qualifying, you have loan approval.
It's crazy. Hey, whatever the loan officer put in the income, yep, you qualify. Now it's verifying. It's like proving yourself innocent compared to, you know?
Yeah,
at that
interesting. So, you know, and that's always kind of been the thing with broker. I mean, I think from, you know, a refinance standpoint, it's a different ball game than if you're buying a house. Like,
absolutely.
If you're buying a house, there is a timeline. That timeline is pretty, it's expected.
Your earnest money deposits on the line. I mean, that's like, hey, I don't want to, you know, swift kick to the growing. You know, hey, thanks so much. You signed off your contingencies. Oh my God, you don't qualify. You didn't tell me that your income came from commission. You know, it's like, wait.
Yes, I did.
Yeah,
I told you I sell cars for a living.
Yeah, it's like, well, I've had your W-2. It's like, so what? W-2 doesn't break down the income. Right. So those are legitimately what was happening.
And so, you know, when stuff like that happens, you know, you get to the 11th hour, and I know you get these calls. As the Mortgage Geek, people know, like, okay, you know, 4-alarm mortgage fire, call the Mortgage Geek.
Call it, yeah.
So you get the call, and then, like, what do? How do you save the day when someone's 24 days in, and they're like, I don't have a loan, and we already released contingencies, and we're supposed to close in a week? Like, how do you come?
I mean, I did a pretty cool closing. Patrick Mercer, thank you so much for reaching out to me for your buyer. He sent it over to me. They got a denial like way late in the game, and I just quickly looked at the paperwork, and I just called out why it wasn't ever going to get approved on how it was submitted. And he was like, cool, man, I know I'm in the right hands. Because I was like, hey, there is a loan here, but we have to move it over here. So you just have to speak intelligently to not only to the client, but also to the listing side and to the buy side to let them know, this is how I'm going to overcome the obstacles, and this is why I will close fast, and you know, everything's already open. The prelim's already open. All I have to do is disclose really quickly. I already have all the paperwork. Go get my appraisal done in 3 days. But, you know, so we try to save those deals by putting them into the right program from the beginning. And folks, like, you know, if a bank offers you a 1% and you can't close, then your rate is not 1%, right? So just move forward with like an agency loan.
So you would call the listing agent and say, hey, listen, I got this deal just now.
Yep.
But don't worry, we have a loan. Hang in there. I may need a couple extra days because you're supposed to close in a week. It's going to take me 11 days. That's as fast as you can do is 11 days, right, with the disclosures?
Yeah, with like, well, I mean, you can do it a little bit faster, but technically it's like right around 9 to 11 days, yeah.
Okay, so somewhere in there, so you ask, hey, listen, we might need a couple extra days, but we're going to get this loan done. Here's how we're going to do it. Because essentially what it is, and where the mortgage geekness comes from, is the understanding of how the loan is supposed to be put together and submitted so that it can be packaged and ultimately moved on. I mean, that's where it's how do we take all this data here, organize it in the way that works for the inline investor.
For sure. Yeah, absolutely. Instead of just, oh my gosh, I just need the lowest interest rate because this one place offers it. It's like, that's just not how a loan is, right? Yeah. And flip side, another one, I've been getting calls a lot. Like, I'm not saying that, like, I'm the best in the world. I'm just I get a lot of calls like, hey, is this true? Hey, what's going on? I have a new hotline coming out, you guys. Just shout out. Oh, it was my birthday yesterday, too.
Hello! Hey, HBD!
I turned 28.
How old are you, though?
I turned 28. No, 38.
Are you really?
Yeah.
Welcome to the club.
Thank you. It was actually kind of funny. I was like, I had a balloon that says 38, and then my Chris partner, finance boy, came in. He's like, dude, you're like too young for that. Get rid of the 3. And he's like, you act like an 8-year-old.
Finance boy. I love that. That's such a great name for him. What's up, Alicia?
But
she said Sean can do it. That's right. And
thank you.
That's what people know. People know the Mortgage Geek.
Felicia's awesome.
Yeah, she is. She actually is a
Compass, what a
person.
cool move.
Yeah, we have to talk about that one of these days too.
Yeah, there's a lot to talk about.
Crushing the market.
They are
unbelievable. I got a text from another good high-producing agent at Keller Williams yesterday. Said, "I started Compass Friday." It's like,
wow.
Okay.
Wow.
Yeah, very interesting.
Really quick, I'm going to go back to this because it'll take me like 2 seconds, so I'll talk fast. I literally got a loan, and the guy had a 228% debt-to-income ratio. But Chase brought him all the way to day 31, approved him. Oh my gosh, yes. This is what I'm talking about on those conditions. Just because you have a conditional loan approval doesn't mean anything.
That's scary for buyers.
And I was like, what? How did somebody, and the underwriter's like, well, I asked for this one document as soon as they proved that, I can't go into too much detail, but, oh yeah, that company doesn't exist anymore. Oh yeah, that's a good one. Like, you don't ask for that up front. So literally the loan officer signed off contingencies 31 days into an escrow expecting to close, and they get a denial. I get it. I just went through it with Matt because Matt had to do the rental schedules. I just looked at it really quickly. I was like, not a chance. 228% called listing agent. I'm so sorry. You don't have a deal.
Matt, a genius, by the way.
Yeah.
He's the Mortgage Geek apprentice.
He is.
And
He's
has
been
been
with me for 5.5 years.
Yes, yes. Val also. You have such a good team, such bright people.
Yeah,
for
thank
people
you.
who don't know Team Kahan. Blair, I mean, you have some amazing people on your team.
Jason, Chris, Cassie, I mean, Anna runs all the, she's been with me for the second longest as well. So I got a team that's like super deep with knowledge.
So let me ask you this, because you're talking about how they're pushing loan approvals through. Brokers, retail banks are doing this, which retail banks are not known for doing this.
I know.
Why is this happening? Is it because they're trying to keep people busy and act like things haven't changed? Or is there some sort of strategy to like, well, let's just get them down here, and if it's not a deal, who cares? Screw them.
Yes.
That's what it is?
I heard that through somebody else, like, just get them in the door. Just say yes to them. Doesn't matter. The likelihood of them going somewhere else after they've already came to us, even though we're going to change it, is less. So just say yes to everything. Yes, we can do it. Yes. Yes, we can get it. Oh my gosh, yes. Oh, you qualify under this program. Oh, our non-conforming 5% down doesn't even exist. Oh my gosh, yeah, this is what a rate is. Oh no, you know what? We got to switch this over to agency. Your rate's, 4.875%. Oh yeah, we also need 10% down. But you're already 2 weeks in. Sorry. That's literally what they're doing.
So it's got to be part of the strategy, because there's no way they would just switch gears like this.
Yeah.
Because like brokers aren't known for doing this, and retail banks aren't known for doing this.
The business in.
So it's sort of a scramble, because less units in a smaller pie means that people start getting a little more aggressive, let's say,
absolutely,
than what they traditionally would be. I'm surprised to see it from the retail banks on the big time. Brokers as well, because brokers usually, they want, because when you're a broker, it's like, okay, there's the outside guy who's the broker, and then there's the actual place that's doing the loan. And the actual place that's doing the loan doesn't want a junk file.
No, they don't.
They won't even look at it usually.
They don't care anymore.
They don't care anymore. So
50, 80 conditions, it's a job.
So they're not busy enough.
They're not being laid off.
Gotcha.
There's a lot of layoffs. Movement. Last year, how many people did they lay off?
Quite a few.
800 or something?
Yeah, I thought it was about 1,000, yeah.
That is a massive number.
Yeah. And so if you're not doing that, then something else must be going on.
Yeah.
Like on these big bank sites. Interesting stuff.
It's very interesting. You know what? I've gotten to the point recently, I used to be like, come on, it's not. I promise you. Like, I used to talk until I'm blue in the face, but what I'm learning, of what I have learned, is that people just want to hear what they want to hear at the very beginning. And so sometimes it's like, all right, like, okay, go over to them. I can't change your mind. I'm not going to sit here for 5 hours and change your mind. I just hope that my real estate partner, like, when I'm telling them what's actually going on, that they're trying to help sell that as well. But ultimately, in the very end, it's, well, why would this guy lie? And then 25 days later, they get upset. So
should you, as a buyer, should you run a backup loan? Like, is that something that you can even do, or is it something where you just...
You can, but I wouldn't, as a loan officer, I wouldn't run no backup loan and be like, come with me the right direction, or I guess come to me later.
I'm just thinking from a standpoint of, like, especially when you know, like, this is not going to work. I know they told you, but I know how to structure this deal. There's no way the loan officer on that end knows what to do what I am doing here. I'm sure that happens.
It does, but then also I have to be very careful because, like, there's some impossible loans, and they did get funded, and I was like, that underwriter just missed it. So that's happening too.
Wow.
Because a mortgage bank, you guys, a mortgage bank can upload to Fannie Mae, or even like an institutional bank. Anyone can upload to Fannie Mae. And it's not like, so like when we sell a mortgage to, let's say, Cornerstone Funds, and we end up not servicing it and selling it to Wells. There's someone on the Wells side that's the recipient. There's actually another underwriter there that's actually going to underwrite it to make sure that the loan that you're selling them is
what you told them.
What you told them, right? And everything is checked, like the income and all that kind of stuff. Well, now Fannie, now Freddie, sell direct, upload it. They will do the review later.
Are they doing those reviews?
Yeah.
They are.
Oh yeah. They'll sell you the loan back.
Is it like, I was gonna say, like, is it like more like a border check, like where it's like one in every like 100 cars gets checked? Kind of
I
thing?
don't know how many get checked, but I'm under the impression that they do end up checking all of them.
Okay.
I'm under this impression. Don't hold me to it. I can ask my partner Eric. I mean, he knows everything about it. But I mean, they will check it. So.
Because if they aren't.
Then they just rebuy loans you later.
Right, but that would be a problem. If one day they woke up and went, hey, let's start checking these files more often. Let's go back for the last couple years.
And they can go back a long time.
Right? So if they decide to dig in, because I don't know if you saw this, but Fannie and Freddie, there was a leak from the FHFA, a big meeting that took place where they told everyone on the board to prepare for Fannie and Freddie to be released from conservatorship.
Oh yeah, I know for sure I bought the stock.
Did you buy it? Okay.
Absolutely.
I've had it for a long time. I've been waiting for this.
Yeah, same with me. I've been looking at it like, hey man.
So I've got Fannie. I don't have Freddie, but I have Fannie, and I've had it for years. And so the stock has gone up dramatically in the past month. Now, one of the things that could come along with that, if the CEO of Fannie Mae makes what a CEO of Fannie Mae should make instead of making $295,000 a year, which is what the CEO makes right now. What? $295,000 a year. So
to run a $4 trillion book?
Yeah. So you should be making like 20 million. So if you go and get the guy.
Minimum.
Yeah. Go and get the guy.
I'm happy for you to make 20. I want you to get paid 100.
You should make more.
Yeah.
But let's say they go and get the $20 million guy. What are they going to do to cover their booty? It's not the government anymore. It's someone who's looking at this from a profit perspective, from a protection perspective. Let's go cash in all of our insurance on all this stuff, on all this paper, before it gets too late. While these guys can still write us the check that they owe us or repurchase these loans, that actually could be a bad catalyst for the market in general.
Absolutely. I think there was an article that I was reading, and I'm trying to envision it so I can remember what the terms were, but something about how much capital that Fannie Mae and Freddie Mac had to actually hold if they did get out of that conservatorship, right? And it would be like, under normal terms, like 500 million, or no,
billion.
500 billion, or some crazy number, right? And they're like, that's impossible for us to hold that much actual cash. So that's another thing, that it could go down the line going, well, hey, we're just going to sell all these shit loans, right?
Absolutely.
So
You're going to have to raise the capital.
We just don't have the capital to back all of them. And I see that you uploaded a 65% debt to income ratio. Just change it because we didn't verify it. Hey, sell this back to you, because right now some of the larger companies that are doing that are strictly just doing it based upon the fact that they just, it's kind of like a cost of doing business, right? They're just doing it on a low end scale.
Yes.
Yeah.
And as of right now, the Treasury is sweeping over $100 billion a month in profit from Fannie and Freddie.
A month now?
A month.
I know it's 40 billion, but 100, I mean, that's incredible. I don't think they're ever going to let that go.
Well, I think this administration is pushing hard for it now. And I think the wheels are in motion.
Wow.
And that's what that meeting was about, and that's the reason why the stocks spiked so much, is because the people who were in that meeting, it only takes one. One person was like, oh my God, there is billions of dollars to be made owning these stocks. I have to tell someone.
Yeah, correct.
And that's all it took.
Yeah.
And that's an insider, piece of information. It shouldn't have been released. There's a whole investigation that's been launched this week as a result of that. And someone's probably going to get in big freaking trouble. But the cat's out of the bag. And so if they stop sweeping that money in the Treasury, they will quickly be capitalized. And they get a proper CEO in there and right that ship and get it running less like the government.
$100 billion profit a quarter? That stock will skyrocket.
Yeah, dude, a month between Fannie and Freddie. A month. It's a month. Cash. That's just getting swept in there.
Bonkers.
It's
Love
huge money.
Yeah.
So you take that out of the government's hands, put it in a proper business person's hands, and watch those companies flourish. I mean, and I'm not saying stock picking or anything. I bought it much lower than it is right now. But, Fannie and Freddie are stocks to take a look at, throw a grand at it.
It was
or
up to
something.
an 80, wasn't it at $80 in like
Yeah.
2006 or something like
Uh-huh.
that, 2007?
And remember back then, there wasn't as big of a percentage of the paper going to Fannie and
No,
Freddie.
not at all. No.
There were so many other places where paper was landing, so much what we call now non-QM or
I mean, Fannie Mae was
subprime.
like annoying. You wanted a pay stub? Get out of here. I'll sell to this guy with the same rate.
Who cares? It's an arm.
And all he did was breathe on a mirror.
So, that
Wild, Wild West.
So now think about where we're looking at like 80% of the mortgages or more, 80 to 85% of the mortgages are going Fannie Freddie.
Yeah. Absolutely.
Versus back then it was like 60. So put some extra zeros on the possibility with that stock. If you just look at the outstanding shares right now and the money they're making, they've done the math on this with the same PE that any other bank has. It's just the simple 10 PE. The stock's worth like $350.
Oh my Lord. I hope. Wow. Split, split, split.
I'd be super stoked. So would my boy Mathin, who I know is going to watch this.
Mathin, what's up, man?
Hang in there. Hang in there, baby. Okay, so we got the Mortgage Geek hotline's coming up.
Yeah, the hotline. So it was awesome. So I just got a call. No, I was in a meeting with Blair and I and with an agent, and they were like, well, this, Veterans United told me this. And I was like, well, I'm so sorry, that's not true. And she was like, oh my gosh, we just fell out of escrow because of it. I was like, all right. So then we were like, you don't have to tell me your name. Or you have to, well, if you want me to call you back, I guess. But I'm not going to try to recruit you. I'm not going to try to do anything. All I'm going to do is just, people are going to call in. I'm going to have the guideline, the actual guideline for it. I'm going to have the gray area for it. I'll go down the hall and talk to my underwriting manager. I'll talk to my partner, my operations manager. I will get the actual answer for you, respond by email, call you back. And it'll just be a place where it's like, is this true? Because there's a lot of that going on. So just use me as a resource. So you can go to also mortgagegeek.com and
You should do a
all the
spin on
resources.
deal or no deal. Like either you have a deal or you have no deal.
Yeah.
You should totally do a spin on that.
We're going to do like one a month.
Okay, that's
Yeah.
awesome. And then we are actually shooting tomorrow a rap video.
Oh, man.
Please hang in there for this one because
Yeah, homeboy, you got that right.
Posting a video today.
posting videos. Oh, is that one done today?
Yeah, the dad jokes.
Dad jokes.
Oh,
Awesome.
propositions.
And
Yeah.
propositions. Yes, the
Yeah,
dad
yeah.
jokes. So that video's going to be
Save
posted
on
today.
property taxes. Save on property taxes. Most people don't know about
Check
that.
out the Mortgage Geek on Facebook. He's here live. We got to check out. Awesome stuff, man. Great to see you.
Hey, good. Thank you.
Tremendous content as always. Go like the Mortgage Geek on Facebook, YouTube, and the Instagrams, and share this video to make your friends smarter than everyone else.